Welcome to the desk. You're here because you're absolutely ready to step up from retail guessing to true institutional precision. And honestly, I'm thrilled to have you joining the team. Today's explainer is going to be your direct guide to demystifying the commitments of traders, or COT report. This is the exact framework we use to decode the gold market. Okay, let's dive into this.
Here's a quick look at our onboarding syllabus for today. We're going to build your knowledge from the ground up, starting with basic positioning and progressing all the way through to our advanced intermarket strategy and proprietary scoring matrix.
Section 1. The high-stakes poker table. This is the foundation of why tracking institutional money is absolutely crucial. Listen, every single day, retail traders are bombarded with a complete fire hose of noise, right? Geopolitical fears, inflation narratives, talking heads on financial media, but all of that is just opinion. The COT report, which gets published every Friday by the CFTC, is obligation. It's a literal legal audit of actual futures contracts backed by billions of dollars in margin money. Retail traders lose their shirts trading on headlines. We, on the other hand, trade on binding financial commitments.
Think about it this way. Would you ever sit down at a high-stakes poker table where the casino legally forces every single player to show their cards, but you just choose to keep your eyes closed? No way, of course not. But you know, that is exactly what traders do when they ignore the COT report. The core principle of our desk is simple. Never, ever trade until you know exactly who you are trading against.
Section 2. Decoding the market players. Let's move to and see how this builds.
The CFTC actually sorts every large trader into 5 distinct tribes, and their motive completely dictates their future behavior. First, you have the miners, who are just hedging their physical production. They're not speculating. Then the banks acting as swap dealers. The hedge funds, or managed money, who are your classic momentum chasers. The institutions, which act as your slow-moving smart money. And finally, retail, who, let's face it, almost always arrive late to the party.
Now, the most critical dynamic you need to grasp right now is the relationship between those swap dealers and managed money. Retail traders look at the Wall Street banks holding a massive short position and immediately think, oh, the banks are betting against gold. They aren't. The banks actually act as the house. They just intermediate trades, meaning when the hedge funds go aggressively long, the banks take the other side simply to match the transaction. So the banks are betting against the speculators, not the metal itself. And historically, the house wins.
All right, now we go a bit deeper. Look at this number, 10.15%. This is the spreading ratio for managed money from May 5th, 2026. This specific metric tracks when hedge funds hold simultaneous long and short positions to hedge their own directional bets. Anything above 10% puts us squarely in the warning zone. It tells us that despite a massive net long headline number, the hedge funds are terrified and are quietly buying insurance. It's a real game changer, a volatility precursor, signaling exactly when we need to start scaling back our own positions.
Now, what's really interesting about this slide is the behavioral divergence between the tribes. We track what's called the smart/fast ratio. Here, institutional smart money is sitting at roughly 69,000 net long, while fast money hedge funds are at 94,000. But the raw numbers don't tell the whole story. It's the directional change that matters. The smart money was quietly reducing their position, while the hedge funds were still aggressively buying. It's like the iceberg is withdrawing while the speedboat just keeps accelerating. That is a massive red flag.
Section 3. Calculating the COT index. Let's shift from qualitative observation to giving you a true quantitative edge.
Because honestly, raw contract numbers are basically useless without context. A 90,000 contract long position means something very different today than it did, say, 10 years ago. So the COT index normalizes these raw net positions into a 0 to 100 percentile rank based on a rolling historical window. It essentially allows us to compare current data against past market regimes on a true apples-to-apples basis.
So here is your exact math for setting up that 156-week or 3-year rolling window. First, you download the CFTC data. Second, calculate the net positions by simply subtracting shorts from longs. Third, find the 3-year minimum and maximum net positions. Fourth, apply the index formula to find exactly where the current week sits as a percentage of that range. And finally, plot it against the price of gold to spot those crucial divergences. Once you map that index, it's going to fall into specific zones. If the managed money index drops between 0 and 20, speculators have completely capitulated. That is extreme pessimism, and that's when we start looking for buying opportunities. But if it reads between 80 and 100, speculators are downright euphoric.
When you see an 80+ reading, you need to adjust your risk limits immediately because the historical probability of a vicious correction is heavily elevated. But actually, let me share a humbling mentor's lesson with you right now. The COT is a timing tool, it's not a magic 8-ball. Between 2010 and 2011, gold went on this massive bull run. The COT index stayed pegged at extreme optimism for months. A strict, emotionless, mechanical trader would have sold early and missed a 60% rally. Why? Well, because the COT measures paper futures. During that cycle, real physical demand from central banks and Asian consumers completely overwhelmed the paper market. So always remember, the physical market is the ultimate arbiter.
Section 4. Intermarket Validation Dashboard. Because gold does not trade in isolation.
This dashboard is exactly how we validate our signals. We cross-reference the gold COT with the COT reports for the US dollar, the 10-year Treasury notes, and gold miner equities. Look, if hedge funds are heavily long gold, but they're also long the dollar and short bonds, their thesis is internally contradictory. A coherent, structurally sound long gold trade requires hedge funds to be short the dollar and long bonds, betting on falling real rates. If this dashboard doesn't align, the trade is fragile. Simple as that.
Section 5. Weekly Checklist and Matrix. It's time to synthesize all this heavy data into a rapid routine you'll use every single Friday.
Okay, this is your repeatable 6-step weekly protocol. Step 1. Calculate nets. Step 2. Verify the zero-sum balance, ensuring every long contract is mathematically matched by a short, just to catch data errors. Step 3. Assess Tier 2 divergences, like that spreading ratio we discussed earlier. Step 4. Consult your intermarket dashboard. Step 5. Normalize the data into the COT index. And Step 6. Apply the failure checklist to make sure physical market fundamentals aren't overriding the paper positioning.
All of those steps feed directly into this, our simplified scoring rubric. You assign a +1, 0, or -1 to each metric. Let's look back at May 5, 2026. The index was at extreme optimism, banks were adding shorts, and institutions were selling. That generated a score of -7. And a -7 means strongly bearish risk levels. This matrix is fantastic because it gives you a rapid, purely mathematical way to determine your trade decisions without an ounce of emotion clouding your judgment. Section 6. The Mentor's Parting Wisdom. Here is the ultimate executive summary of everything we've covered today.
So the crucial point is that this entire system really boils down to 3 laws. Law 1, motive over position. A miner short is just business, a hedge fund short is pure speculation. Law 2, extremes reverse while trends persist. We are looking for crowded boats to identify elevated risk, not just blindly fading trends. And Law 3, the physical market is the ultimate arbiter. I want you to write this down and literally stick it to your monitor. Extremes reverse, trends persist. But the physical market is the ultimate arbiter. The COT framework gives you a massive statistical edge, for sure, but institutional reality always dictates the final outcome. Respect the data, absolutely, but respect the physical metal more.
Well, you've seen the edge this provides. You understand why retail traders get completely wiped out and how the smart money actually positions itself. That Friday data drop is no longer just noise to you, it's your blueprint. So, I leave you with this one question. Are you ready to stop gambling and finally start reading the cards? Let's get to work.